Hey, what's going on, everybody? Welcome to the Born Investor Breakdown, the show where hype fades, risk cools off, and real wealth takes center stage. I'm your host, Stock Market Jay, and every episode we cut through the noise to reveal the slow, steady, proven strategies that actually build long-term financial freedom. So, no daily news drama, no get-rich-quick schemes, just practical investing, quiet growth, and money that works as hard as you do. And let's break it down the boring way, right? We already introduced this new series that we're going to be working on. If you haven't tuned in, if you haven't tapped in, please catch up on the last episode. It just uploaded, and that's just an introduction to the Boring Investor series. And essentially what I'm doing is, like I said, like I just titled it, we're coming in, cutting through the noise. We're giving you rational, practical investing philosophies and value systems, right? This is not financial advice. Any tips or tricks I give you, man, do your own research. Always make sure that you're well prepared and ahead of the curve in terms of the money that you're going to be investing and spending in terms of the investments that you do make. So definitely do your due diligence, do your own research before you invest. Don't listen to me. Get your own investment philosophies, theses, and kind of build your own idea and perspectives around the investments that you make and how you grow your money and do what works best for you, which is essentially what today is going to be about. It's going to be about how to determine your investing style, your investing strategy, and setting yourself up for success in the realm of investing. A lot of times what people fail to realize is, what they don't understand is, when it comes to investing, you have to have a game plan, right? You don't want to be one of those people that are just jumping in, you're just buying stocks, you're just chasing the latest trend, you're just doing what you see people around you are doing, because then when you get the result that the majority of people get, which is typically losses, most people experience loss in the world of investing in whatever investment vehicle, whether it be stocks, whether it be crypto, sometimes real estate and different things of the sort, simply because they didn't understand the rules of the game and they didn't have a game plan going into the game. So if you're not failing to plan, then you're preparing to fail. So just take that with a grain of salt. So when it comes to strategy, is how you manage your portfolio, right? Buying and selling essentially is what it's going to be. Capital allocation, where you should be diverging your dollars, your new capital into the markets, when you should exit previous positions and when you should enter into new ones, how you should enter into new ones. And then of course, style is going to be, are you a growth investor? Are you a value investor? Are you an income investor for dividends? Value and income can be one and the same, interchangeable. Are you a long-term investor? Are you a short-term investor? Are you going to be a swing investor, swing trader, right? You're coming in and out of positions, whether it be a week at a time, a day, couple of seconds, couple of minutes. For some people, day traders, option traders, they get in, they get out. And it's nothing wrong with that. That's not how I operate. I'm going to buy, I'm going to hold. So I'm going to get in, I'm going to stay for a long time. I'm going to get every penny out of that stock, out of that wonderful business that I own, and then I'll eventually get out gracefully, right? That's the name of the game. The name of the game is to make sure that when you invest, you know where you're going, you have an aiming point, you have something to be a target for you on your journey. And then, of course, when you hit that target, which is going to be the strategy, how do you exit? Because, you know, you got to enter, exit, sometimes to do absolutely nothing at all, be patient, accumulate capital on the sideline. So when those opportunities present themselves, you can go in. A good way to find out your investing strategy and your style, and I'll go over those, but I just want to give the building blocks to what that is. Mindset and temperament. You won't have to invest in a manner in which suits your mindset, that suits your temperament. Do you have a long-term mindset? Or you're a person that can delay gratification? Or you're a person that's like, man, I need this today. I want to get rich now. I need to feel like these gains are gaining right now. Like, I need to be able to see it. I came in, I made a bunch of money. It happened for me. I'm happy. I'm content, right? And everyone's different. So you got to know who you are as a person, and that'll help dictate and determine who you are as an investor. In my experience, this is just me personally. I do what works best for me. I'm a long-term growth-minded person. I believe in, compounding my daily habits and daily rituals and things like that are the building blocks and lay the foundation for the springboard that's going to be the success that I see. And I take the same approach with my portfolio, right? Consistent, steady investments over time. And my goal is to let time do the heavy lifting and ensure that I'm getting the things that I'm looking for out of my investment dollars, right? The return on my investment, the yield, the money I get back as my dollars grow over the long term, right? But I don't have the temperament to be able to get into an investment and know that I have to watch it throughout the duration of the day because it could possibly go down. I would be on eggshells. I would be on edge. It wouldn't work. I couldn't do it. So when I invest personally now, like I said, I'm buying and holding. So I get paid. I'll put some money into the portfolio, buy whatever stocks that I see that I would like to allocate more dollars to at that moment in time. And then, of course, wait until it's time to do it again. Simple as that, right? Simple enough. I don't have to, like I said, you're going to do the research. You want to do your due diligence. So I am an active investor. I just listened to Gap's earnings call today. Stellar, they crushed it. That's one of the companies that I own. I did say I'll be revealing the stocks that I own over time. What I'm going to end up doing is a series where I give breakdowns on each company's earnings call. Gap is lucky contestant number one. They just had a stellar earnings call yesterday, and I'm going to be doing a take on them here coming up soon. So Gap is one of the companies that I own. And like I said, you want to make sure that you're doing your due diligence in terms of, are you keeping up with the stories of these companies? Because here's the strategy is buying and selling portfolio management. You have to keep up with you have to come up with an investment thesis. Why are you buying this stock? Do they have a distinct competitive advantage? Are they fundamentally sound? Do they have amazing management team at the helm guiding their decisions and how they grow the business? Are they financially sound enough to be the next wave and continued wave of whether it's innovation, whether it's just staying afloat, whether it's mitigating tariff impacts or headwinds, supply chain restraints, things of that nature have to be managed by the management team, right? So you want to make sure that they're a solid enough company, being able to move in and out. So understanding, hey, I bought this stock because of this story that I built around this company. And if that story changes, they take on massive amounts of debt. If they get rid of the CEO, if they start doing unethical things or stop doing the things that they said they were going to do on their earnings calls, and different things start to transpire, then you might want to take a different look, a look through a different lens of that company, and then decide, man, have things changed, or am I still aligned with this business on a long-term perspective to continue to hold, right? So that's the reason why you buy, because of the story, and the reason why you sell is because potentially the story has changed and no longer aligns with your investing goals. So that's how I operate in terms of strategy, right? And then you want to understand and hone in on, when do you buy? Is it dollar cost averaging, or are you just buying a consistent amount over time, throughout time, or are you going to just load the truck, back up the truck, buy a bunch of this one stock here, buy a bunch of that one stock there at different times as, those opportunities present themselves? Like I said, with my temperament, I can't jump in and day trade or options trade and the stock, you go up 100% in less than a minute, and then next thing you know, you're crashing like a brick, coming from the a two-story building, and you don't know what's happening, right? I can't operate like that. I don't want to have to keep looking into my portfolio, checking it, managing it like that. I would rather manage my portfolio by way of continuing to do fundamental analysis on those wonderful companies that I own, just slowly over time, as a joy, as a hobby, as opposed to I got to sit here and basically work my portfolio like a job. I want my portfolio to be on autopilot, so I can't be in risky positions where they go up drastically and swing down drastically. Now, I do have growth positions in my portfolio. They can take swings either direction at any given time. Of course, they're mid cap, small cap companies, so that's, understandable. It's the nature of the game, but it's not to the point to where I'm concerned, right? Because I only have 4 growth companies in my portfolio. The other 3 are dividend/value. And then, of course, those growth companies, they are the makings of what I told you want to be invested in: strong, solid, management team who knows the direction that they're going in, paving the way for innovation or just growing the business fundamentally, structurally sound, competitive advantages, partnerships, vertically integrated, things of that nature, strong financial balance sheet, and they are undervalued in terms of, maybe the underlying business and assets compared to the stock price. The markets just haven't caught on to it. And that's okay. That's fine by me. You can stay invested into things when the prices are low. And typically prices are low when either the company's out of favor with the markets, or if the markets just haven't caught on to it. Sometimes it's just a matter of the company becoming profitable, then boom, just like that, that stock explodes. That's what happens, man. No company starts off profitable. It's okay. Do you have the makings of a sound, structurally solvent company that can, make prudent enough investments to be able to become the next Amazon, Tesla, Apple, Microsoft, things like that? Yeah, think about it. These companies didn't start off as juggernauts, as giants, as profitable businesses, right? They started off burning through cash, losing money yearly. And of course, maybe albeit they were innovative, disruptive, and of course became the juggernauts that they are, they had to go through those cycles of, startup, small business growth, and then established company. And then of course you get to that point where you either decline or you reestablish yourself as a player and continue the upward trajectory. That's where every company goes through their cycle, and you just have to make a educated, sound investment decision when you're buying those types of stocks. Like I said, I only own 4 growth stocks. I don't lose sleep behind owning those 4 because, of course, they crush earnings every single quarter. They're vertically integrating mergers and acquisitions, research and development. They're reallocating those dollars the way I want to see them. As an investor, you have to understand businesses, one of their lifelines is free cash flow. This is how they reinvest into the business, whether they're buying back shares, whether they're spending money on research and development, whether they're spending money on new technologies, new innovations, or whether they're spending money on buying other companies, whatever the case may be, right? Paying down debt. This is where the money comes from. So you want to make sure that you're invested into businesses that are checking certain boxes, such as operating cash, revenue, free cash flow, and earnings. If they're checking those 4 boxes every single time, those are the big 4 numbers, and they've been growing those numbers consistently over time, that's a business's engine. Likely that's a growing company, and you can start doing more research and getting more security and knowing that, hey, eventually that the stock will explode because the business is growing. There's no way a failing company's stock can grow long term. Don't get me wrong. You can get some GameStops, you can get some whatever meme stocks that they have going on where they just explode, go on massive tears. They eventually come back down to where the fundamentals suggest that they should be trading at, which is pretty much nothing, right? And then you have companies that either they trade sideways or they go up and down with the markets as the market moves, and they never really just explode. But the business as a whole fundamentally is structurally sound, and they have no reason for the stock to be repressed and suppressed and depressed the way it is. That's just how the markets work. They're irrational. The stock market is the only place where you can have a business that's been growing for 10 years, 15, 20 years in a row, and the stock still hasn't ballooned and taken off yet, just simply because it's not that time. They're not either profitable yet. They haven't come in favor of the markets. The world hasn't caught on to them because, as you know, once the world starts to catch on, and you get those retail investors, you get those speculative investors, you get those gamblers or whatever come in, and they start driving the price up. And then, of course, you have the hedge funds, the big money people that are on the back end pulling those strings and driving that price and things like that. Of course, you want to understand that, like I said, you want to understand your mindset. If you're delayed gratification, long-term kind of minded person, then you might be good taking the long-term approach, dollar cost averaging and things like that. If you're a person that you want your money now, it's your money, you want it now, get it quick, get it how you live. There's nothing wrong with that. Get in, get out. Just make sure you do your due diligence and you learn how to play the game. You learn how to do it safely, practically, and intelligently. You will be okay. It's no wrong answers when it comes to investing. I won't say my style is better than someone else's. I will say that mine works best for me. So you do what's best for you. You don't want to be a person who is like, you want your money right now, but you buying stocks and you're like, man, I'm gonna hold this for 20 years, and you're just like watching paint dry. You're gonna go crazy, you know what I'm saying? Whereas opposed to, you get in and you find those investments where you do get in and get out, and then you still want to make sure that you do what works best for you, but you also mix in a sprinkle of the inverse. You mix in a sprinkle of what doesn't work best for you, or the things that you don't do well, but it's fun to do. So for me, long-term investor, stocks, REITs, precious metals, and then of course, high yield savings or debt markets and things like that, right? That's the extent of it. Now I swing XRP sometimes. I've been watching it for quite some time. It'll drop down to a certain amount, typically around $2, $2.20, and it go up to like 280, 260, $3 or something like that. Of course, since crypto is crashing due to Bitcoin getting pulled down, it happens all the time. I'm not even a crypto enthusiast or investor, but I know how the crypto things that I do to speculate. Does it work? Yeah, it works. It's not exciting. I don't make a bunch of money at one time. I'm not putting a bunch in there. I'm only putting in what I'm willing to lose, right? And then of course, that's pretty much how I speculate. That's how I gamble. I have another kind of speculative bet that I'm hedging on, which is going to be, it's a company called Avant Brands. It's a Canadian weed, marijuana stock. And of course, they grow, distribute, retail, and medicinal marijuana through they're multinational. They have the global reach across the entire world, right? They've been growing their business vertically, integrating like crazy, loads of cash, no debt at all. And they've been growing the business steadily over the last few years. Of course, the marijuana industry is heavily regulated on the state and a federal level. So of course, a lot of those big names that are in that space, their stocks have been getting beat and crushed like there's no tomorrow. But I continue to invest in them because they're growing the business fundamentally. Nothing about what their stock does on a day-to-day basis, or even on a, let's say, 5-year squeeze, 10-year squeeze, has nothing to do. It doesn't suggest that the business is failing. Just because the stock is repressed because of government regulation and things like that, federal regulation and things of that nature, and especially because that business, the marijuana, the weed industry, isn't favorable to a lot of people. It's kind of frowned upon, taboo type of deal, right? So just because those things are going doesn't mean that the business isn't fundamentally sound. They're growing the business. They've been buying up companies that either deepen their pipeline or companies that have been direct competitors with them. They've been growing their revenues. They've been growing their earnings. They've been growing their margins. Their inventories are amazing. They've been kind of deepening their pipeline in terms of the different nations that they're integrating into as far as their footprint on a global scale. Everything about them suggests that the stock should be performing way better than what it is. But since the market's so irrational, and because there are politics in terms of the capital markets, right? It's driven by people, right? It's so it can be influenced negatively or positively. That is keeping the stock repressed. And of course, it's like a 40 some cent stock. I've been buying it for quite some time now. I've seen it get to like not even a buck. I haven't seen it get to, but maybe like 60 some cents on certain swings, and it just comes back down. But it's okay. I'm gonna buy it. I put like that one. I only do like $100 here, and it's only 40 cents. So you imagine how many shares you're getting per $100. I put $100 in once a month, once every, twice a month, things like that. And that's just another speculative. Those are the two speculative bets that I'm doing right there. XRP, I swing it sometimes. It's fun. And this stock, Avant Brand, the marijuana company that I haven't seen a return on at all, I am down. I continue to pour money into it. That's fine. I don't care if it never does anything. I'm hedging my bets with it. But those are the only two that I have that I'm actually allowing myself to get that high risk, high reward. It's fun. I don't get crazy, but it allows me to be able to do that. So if you're a person like that wants to get your money right now, man, day trade, swing trade, options trade, do whatever works best for you, whether you're hedging, no matter how you choose to see fit, and then also have you some long-term plays in there as well. Just as even if you don't care about it, even if you just set it and forget it, just have you some long-term money on the side, earn you a little bit of dividends, and at least just have you something consistent and steady, as your portfolio fluctuates over time, because if you're a trader, your portfolio is going to fluctuate. It's just what happens. Sometimes it'll be up, sometimes it'll be down, because you'll take different hits. Certain things might not go your way. It's a part of the game. It's okay. And then, of course, you want to have your goals in mind in terms of determining your investing style and the strategy. Is your goal going to be income? Do you want to just make sure that you earn as much money as you possibly can in dividend income on a month-to-month basis? If that's your case, then you want to make sure you're aligning yourself to do so, right? Which is making sure that you're investing in companies that have grown their dividends every year for, let's say, the past 20 years at the very least as a starting point. And of course, that stock, you want it to be undervalued so you at least can have a decent runway for growth at some point, because those companies tend to move a bit slower. They'll get there eventually, as long as you buy them undervalued on a price to book, price to earnings, price to sale basis. And then, of course, even if the companies, all of their assets are undervalued compared to the stock price, that's where you want to buy. It might take some years, but you'll get that growth eventually that you want. And then, of course, you will still get that income and, capital protection at the same time. You'll get that yield for some companies as well. Or you're going to be a growth investor. What this means is, are you buying these businesses no matter how high they're trading, no matter how rich their valuation is, no matter what the markets are suggesting for it? You just know that it's going to go to the moon eventually. You don't mind the risk, and you're willing to get in there, and you've done your research, and you know that, hey, this is going to grow. Like I said, I have some growth companies in my portfolio. I have 4. The majority of my portfolio is growth. I love growth investing only from the standpoint of what it can do, how it can springboard your wealth, right? Those slower movers, whether it's blue chip, whether it's mega cap, whether it's large cap stocks, they tend to do well during certain market cycles, and that's fine for capital allocation. As far as growth, it's very minimal. When I was dividend investing, I was making about $150 a month, $200 a month type of deal in income. I was sacrificing that for the growth I was getting as the markets were pushing up. I was only making about, $30 a day, $45 a day. Then I switched to a more growth approach with about, a little bit of income in there. And now I'm making $300 a day, but I'm only making about $20 in income, and that's okay. I'll take that, growth, that capital gain growth in that regards, as opposed to that income. I think the income is going to do what it does over time. It's just going to give me more shares, more buying power. And as I get older and my strategy switches to being more income based, then I'll, of course, I already had the foundation laid for that as well. And then, of course, are you going to be a value investor? Do you want to just protect your capital? I'm looking for pure value in the markets. This company is undervalued. It's not going to swing too high one way or the other. If it goes up, cool. It'll slowly go up over time. I know that for a fact, because it's undervalued in terms of the stock price in relation to what the earnings suggest. And I know it's not going to take a massive swing down, because it might be in a consumer staple industry, meaning something that you need regardless the state of the economy. You need your toiletries, right? You need your toothpaste. You need cleaning products. You need certain things regardless. You need water. You need certain things regardless. Food, energy, utilities. No matter the state of the economy, you need certain things. Okay. And then, of course, just those big, amazing companies, the McDonald's, the Walmarts, the Procter & Gamble's, those blue chip companies, Apple's. I even look at them in that regard as far as just capital protection, because they're a slow mover. Apple's, they might be considered a growth company by some people. The biggest growth is behind them, but now it's just more so stay ahead of the game, keep that cult-like following, protect people's money. That's why they're getting into healthcare with the watches, the bands, different things that they're doing. They're getting into the insurance, and they're getting into banking. Of course, they have the Apple Card, have the high yield savings, different things like that. They're growing the business still. Of course, they're doing it horizontally these days as opposed to vertically with product innovation and things of that nature. So of course, even if it's streaming, they pay a dividend. You get them undervalued, you get the stock undervalued enough, and you'll get enough capital protection. It has plenty of upside, very minimal downside, unless you buy it at a 52-week high, all-time high, in the middle of a market bubble or boom like it might be now, then you'll see very high potential for a downside. But you shouldn't even be buying in that circumstance. You should be patient enough to allow it to come down. The price will always come down to where the earnings suggest that that stock should be trading at, regardless of what the markets do. The markets can run up, go on a bull for 20 years. The prices will eventually correct at some point in between, or come back down very drastically in some event, whether it be a dot-com bubble, whether it be '08 housing crisis, whether it be COVID, whether it be whatever micro or macro scale event that causes markets to get shaky and the people, the investor, the irrational investor to get scared and become fearful. What I want to offer to everyone here that's listening, the boring way, right? The conventional way, the practical way, the safe way to do it is to not concern yourself with a fearful market, a greedy market. And what that means is a fearful market, everyone's selling off, they're scared, they're panicking. The greedy market, everyone's buying, they think the market's going to go to the moon. If you think we're in a bubble, whatever the markets happen to be doing, who cares? It doesn't matter. What you want to make sure you're doing is buying solid companies. You want to buy undervalued, growing, fundamentally sound companies that you understand. That's the name of the game. That's how you win the game. If you do those things and you invest consistently over time, you will win in the game of investing. Point blank, period. That's how it works. Nothing else. That's all you need. If you happen to get into something else, fine, good for you. Take advantage of all the opportunities that are don't blow your account up. Don't blow yourself up. Don't sit here and go chasing everything and you don't understand nothing and you end up losing majority of the time because you're placing bets and gambling as opposed to making intelligent investments based on the research that you've done and the analysis that you've done in the stock market or whatever investment vehicle that you're investing yourself in. Hey, that was a good one, man. That was a good one. Dropping again real soon. Make sure you tune in. Check out my last video where I give the breakdown to the boring investor. I'm going to be breaking down earnings here shortly. It'll either be earnings or it'll just kind of be like a market sentiment type of deal, just to give you like an update on what's happening, telling you not to panic, giving you some bright spots in the market on where you can, allocate your capital, where the investment opportunities are, where you can see the world going, where you might want to be investing your dollar. So until next time, investing family, peace.